Hello and welcome to the Stockout. Happy Monday. I feel like we need a name for today, like it's de-escalation day or something like that. How do you feel about that name, Grace?
Deliberation Day, and
Deliberation Day, maybe. A
something
lot going
take
on,
backsies, yeah.
to say the least. What was that? I didn't catch that.
Just like take backsies or something like that. Like just reversal day, maybe a little bit of that.
Yeah, I was hoping to come on and say, well, I have good news. The S&P is up for the year, but now I look at it, it's down 1.07% for the year, which is still pretty remarkable. We didn't think we'd be there 6 weeks ago. So today, what we'll do is we'll give a tariff update. And if there's time, I can talk a little bit about what Hub Group said on Thursday. I think the implications for competitiveness between rail and truck on intermodal, rail, intermodal, and truckload. And then we're going to interview Aaron Rubin, founder of ShipHero, a friend of yours. So that's what we have today for the Stockout. So before we do that, if anyone is not already signed up for the Stockout newsletter, you can do that at www.freightwaves.com/the Stockout. I would encourage you to do that. And also, head of Freight Market Intelligence, Zach Strickland, and I are going to be hosting a webinar tomorrow afternoon, and I believe that's at 2 o'clock Eastern time. So if you're a Sonar subscriber or get subscribed to the Sonar newsletters, you should hear about that shortly. I think we're still in the process of getting the invite and dialing information out. So we'll talk about tariffs, of course, which is what we'll talk about right now. So the news over the weekend, U.S. and China agreed to suspend most of the tariffs for 90 days while trade negotiations continue, would lower the, quote, reciprocal tariffs on Chinese goods to 10% from that 125%, I guess from the 145%, and then lowers the tariffs on the Chinese tariffs on U.S. goods to 10% also from 125%. And then they also China agreed to cancel these other retaliatory measures like export restrictions on critical minerals, et cetera. There's a separate 20% tariff that President Trump imposed related to fentanyl will remain. And so you have that combined with about the 10% tariffs that predate Trump's second term. So you do have about that 30% tariff. Saw that Citi estimated that's really more like 39 when you include everything. But this Treasury Secretary Scott Bessent said that he would meet again with Chinese officials in the next few weeks on potentially a bigger agreement. So we'll see what happens there. It said that there was a very long and in-depth sidebars, the way they put it, regarding fentanyl. They also spent a lot of time discussing intellectual property and trade secrets and protecting those. So the idea is to establish clear guidelines so China is not ripping those off. And sort of leads us to sort of the question that our old friend who used to be an economist here, Anthony Smith, who's now an independent economist, likes to say, what does this mean for freight? And to answer that question, Craig Fuller, our CEO and founder, just put up an article on the site. If to access, you go to freightwaves.com, scroll down about halfway through the page. And he's talking about freight transportation rates likely surging due to the tariff pause. And I guess the idea is because this is a 90-day pause in the tariffs. There's a picture of the article there that really sort of the risk at this point is that the 30% will return up to that 145% tariff, and maybe 30% is not so bad. So at this point, send the goods in. Yes, you'll be subject to 30% tariff if it's from China. That's a lot better than it could be. A lot better than we thought it was on Friday. I mean, Friday the stock market was happy when we went from 145 to 80%. So this is quite a lot better. I guess the counter argument would be, well, we've had sort of the steady cut of tariff rates, and maybe they're going to be cut down even further. There'll be more collaboration between U.S. and China. Grace, what do you think about that?
I'd happy to see more collaboration, I guess, between the two. I think to say that we leave that partner completely was indescribable when it first came up. I think a lot of the brands, CPG retailers out there that we cover in this space have made some pretty promising investments over in China, as well as and I think even more so in other areas of Asia. So I think clearly the NRF in particular, right, is probably going to be very happy to hear that they're having positive talks with China so far. I think the biggest thing, and we'll talk about this, I think, more with our guests later as well, is how do retailers, brands, etc., move forward from here, right? And we're still kind of in this unknown space of what will happen. Also, what will goods coming in be tariffed at? Are they getting reimbursements for any of the differences between the last couple of moves? And so the way that I feel like the news has been going, especially for this show, the last, couple of months at this point, I would say I definitely am interested in seeing how the week ends. If we see any, maybe more context to whether it is a 90-day reprieve or delay at the end of all of this. So I think, well, it's a very positive sign, and I'm sure those out there, retailers that met with, I believe, Trump last week, are happy to see this. It's still, I feel like, this uncertain space of what's the next move past here, right?
Yeah, still a tremendous amount of uncertainty. But I think there's a reasonable case to be made that there's going to be a surge. Essentially, there's a pull forward of cargo
Yeah.
the last several months up until Liberation Day. Then things have fallen off sort of a cliff. We have this to something to that effect in the sonar chart using the inbound ocean to EU volume index, and so the white line is 2025. That green line is 2024. Really started picking up, let's say, about this time last year, and has been sort of strong throughout that time. A lot of the import volumes have been about 15% above historical levels, and really had that pull forward up until about April. And you see this big drop off. Now, right now, that data, which is based on the data departure, is down 29%. That is using a 14-day moving average, so it's a little bit slow to react. A lot of others have said bookings are down anywhere from 30 to 50%. If you sort of back out that 14-day moving average, it certainly is in that range. And that's pretty consistent with what the West Coast ports are expecting in May. Long Beach is saying down like 35%, given that about 60%, 62% of its imports are from China. LA saying it's going to be down more like 20 or 25%. They say about 40-ish% of the imports are coming in from China. So pretty consistent there. And then it's been interesting to see the last few weeks how, on a relative basis, this next sonar chart shows that China, yes, that red line is what I was showing before, down 29% year over year. You've seen an increase, out from a much smaller scale. Vietnam up 24%, Thailand to US up 14%. And maybe some of those are essentially zone skipping, where those really are Chinese goods. They're just being sent through those other areas to avoid tariffs. Hard to know that for sure. But that's something to watch also. What it means for those things. And kind of the phrase that keeps coming up is this air pocket, that because you have that lack of imports in maybe May and June, given the lead time, some of those weak transportation markets already, like LA. Currently, outbound tender rejection index in LA is only 1.9%. Those could further weaken in the coming weeks, potentially before that air pocket goes away and more freight comes in. But have I missed anything in this discussion?
No, the one thing I wanted to say is that just the zone skipping. I think in that chart we've seen a little bit of that, but I think also at the same time, likely, and this goes back to what I was saying, I think a number of companies have started to already diversify their supply chain out of China because of this, lightly, right? I mean, those plans are probably in action as we speak. And going back to what does this mean for the supply chains, or what does this mean for freight, as Anthony would put it? I'm interested in seeing if companies continue to move forward with some of that diversification, that last minute diversification that they've been expressing and discussing over the last couple of months. Because again, this a lot of these talks, this trade war has been very up and down and uncertain of when the next move will be. And so, how do you backtrack some of those plans, knowing that that's still going to continue forward? So, I'm sure, again, our guests will dive into that too as well.
Yeah, very interesting. At 30%, maybe it's not worth it to diversify the supply chain, or at least not as much.
Yeah.
Just going to spend 1 minute on Hub Group because I think this is interesting for the intended audience of the show, which is shippers. So, the main takeaway I got from listening to Hub Group's analyst call, Hub Group's big domestic intermodal company, owns lots of containers, is that the rail intermodal value proposition remains strong. And some of the highlights here is the rate spread between truckload and intermodal remains high by historical standards. So comparing contract rates to contract rates, it's about a 30% discount to use rail intermodal. So that's pretty enticing for the shippers. And they've kind of sandpapered down the pricing guidance where Hub Group was expecting prices to rise. They said on the previous quarter, now they're sort of saying pricing to be flat for the year. So it sounds like that spread between truckload and intermodal is going to remain high. And if you do see this surge in freight because of potentially surge in imports, the truckload rates tend to move a lot faster than intermodal rates. Intermodal tends to be a year contract. A lot of those get repriced in the first part of the year. So, would continue to look at intermodal. And also, Hub Group was very complimentary of rail service, both on Union Pacific and Norfolk Southern, which they use in the West Coast and East Coast, respectively. They also say that intermodal capacity is plentiful as measured by container availability, where Hub Group has about 20 to 25% of its containers stacked and could handle an additional 35% incremental intermodal volume, which implies that they have some ability to optimize the containers that are already in the field. So if I'm a shipper, I think rail intermodal looks pretty good if my network is compatible with rail intermodal. So with that, Grace, why don't you intro today's guest?
Yeah, so everyone, I want to introduce you to Aaron Rubin, founder of ShipHero, and I'm sure if you're on Twitter, FreightX in particular, you've been following his account. Aaron, I want to thank you so much for joining us and for educating, I think, not only our audience in this aspect, but our audience from Twitter perspective or X perspective, getting used to get a little X on that aspect, and keeping us up to date. So let's start off with just your thoughts of the recent tariff moves. Do you think it'll stick? And what do you think is our best outcome so far from this?
Yeah, thanks for having me. Yeah, I think the trade war is over. I think the idea that it's just a 90-day pause, it's going to be, it's not going to come back. I think the administration seems a little bit embarrassed the way it escalated to that 145%. Like they're basically talking about 54% as what it had been raised to. We're not going to see 145% again. I think 54% is the absolute ceiling it can go to, but I expect 30% to actually come down even further from, it's the 20% from fentanyl, right? And the 10% of the reciprocal. I think they're going to say that China has made a lot of progress on reducing the fentanyl shipments to North America, because basically fentanyl ships to Mexico and then from Mexico to the United States, and use that as a way to lower the tariffs maybe to somewhere around 20%. And the administration was very clear that they do not want to decouple from China. So the whole narrative of, we want to onshore the factories, we want to be making everything in the United States, like that's not going to happen. We knew that wasn't going to happen, but at least now the administration has admitted that it's not going to happen. I expect to see targeted tariffs on, obviously, like we've seen cars, we'll see drones, the steel and aluminum will continue, things like that. But things like apparel and other things that are not strategic, I think 30% is the high. I think it's going to come down, actually.
Yeah, so in light of that, and I think that's a very reasonable expectation, it seems like it's largely going to be business as usual for the most part with those sandpaper down tariff rates. I mean, what do you make of the elimination of the de minimis exemption and how that impacts your customers?
Yeah, so it was interesting to see if they were going to remove that as part of, in other words, put de minimis back as part of the trade negotiation. There's been no mention of that, so let's assume that de minimis is gone. The rest of the world, we say de minimis is, the last executive order said de minimis is going to be removed when systems are ready. At the last CBP meeting, they had a summit last week. They said that they're making a lot of progress on getting those systems ready. So it seems like it's on pace to be removed from the rest of the world as well, although there's some bills going through the House and the Senate that keep de minimis in a smaller way. De minimis has become a massive part of U.S. e-commerce. So I looked at the difference between what China says they export to the U.S. and what the U.S. says we import from China and Hong Kong, because they put the numbers together and we keep them separate. And it's up to about $100 billion. So in other words, the declared imports into the U.S. is about $100 billion less than what the same people say they shipped out of China. And a lot of that is de minimis. So $100 billion of untaxed or untariffed goods has been primarily sold via Amazon, Temu, and Shein. That has put a lot of pressure on American sellers on price, because the Chinese sellers, ironically, actually paid a much lower price than the U.S. sellers, because no matter how high the tariffs went, with de minimis, they paid 0%. With the end of de minimis, we've seen a significant price increase on Temu and Shein, like a doubling or more of price. Well, Temu actually discontinued a lot of their products, and Shein prices have more than doubled. And Amazon, we have yet to see the impact because those items are shipped in earlier, but we will see that impact as well. So, I mean, for U.S. consumers, it means higher prices, but for U.S. sellers, it means more pricing power, so higher margins.
We had, of course, Temu announce right their shipping from within the U.S. as well. Do you see Shein maybe emulating that same strategy moving forward, or do you see them competing in a different way as well with de minimis changes?
Both. So, we work with all these companies. So, Shein has partnerships already in the U.S. So, for example, the Children's Place is not available on Amazon. It's only available on Shein, and obviously, through their direct channels. So, Shein is diversified a bit to have some U.S. brands on. However, their model is very fast fashion. So, using U.S. domestic fulfillment is not just a problem from a tariff perspective. It's a problem from their entire business model, which is very, very fast fashion. Like, they can produce goods and get them to customers in the United States in a matter of like 10 days, where that's not possible if you're shipping ocean freight, right? Obviously. So I don't expect as much of Shein to change the way Temu did. Temu is adding a lot of U.S. sellers. They're pushing very hard to add more U.S. sellers, U.S. fulfillment, U.S. warehousing. So they're going to look more like Amazon, with some goods straight from China, but a lot of domestic goods. So I think we got to separate Temu and Shein. I think Shein is still going to maintain the direct from China model, and Temu is going to onshore more.
Interesting.
Yeah, that's what it appears. Want to ask you, I mean, you do a lot with warehouse management software. I would imagine you have a lot of insight into warehouses. How do you feel about sort of the warehousing availability, right now? Are those elevated? And can you make any distinction between kind of the upstream warehousing near the ports versus downstream, a little bit closer to the consumer?
Yeah, so I mean, Prologis, which is the largest owner of warehousing space, just came out with a report last week saying they expect a significant increase in warehouse utilization and a significant increase in price, because there's been a slowdown in construction. So we did see a run up in stock levels within the U.S. over the last couple of months before Liberation Day, as people front loaded their products. Then obviously that's been burning down a little bit as people reduce their inbound shipments. But we're just really starting to see that. I think the big question now is everyone going to stock up before the end of the 90 days and bring in all their Christmas goods that early, which, typically they come in by September anyway. So this will be pulling up like a month earlier. Mm-hmm. Or are people going to assume that tariffs are actually going to come down and delay their inbound shipments until at the end of, after the 90-day pause? And the third alternative is people are trying to use bonded warehouses to keep their stock so that they can decide when to pull the goods out and pay the tariffs based on the timing of, or when exactly the rates change. The problem with the bonded warehouses is there's just not enough for everyone. So rates have skyrocketed. Normal warehousing, we'll see rates go up a bit. With more chaos means people will just keep more stock in the US, right, to make sure they have enough goods for Christmas. So to expect rates to go up a bit on normal warehousing and bonded warehousing. Like, if you have available bonded warehouse space, like, you probably increase prices at least 50% because the demand's so high.
Nice little Christmas in August. It looks like then more than like. Well, I mean, I'd like to hear your thoughts of the three scenarios you just listed. It sounds you seem pretty positive that likely they will come down. Do you see that that strategy from the shippers kind of holding off, waiting for that possibility happening, or just playing it safe and getting this stuff in here as soon as possible?
Yeah, while I think the rates will come down, most shippers will play it safe for two reasons. One, just the nature of our business being in logistics, we're all risk averse, right? We'd all
Yeah.
rather protect the downside. Second of all, if the rates come down, they probably come down from 30 to 20, right? Which is nice, but it doesn't transform your business. If things go sideways, we've seen how high the administration could go, 145%, right? While the odds of that are very low, 145% is bankruptcy, right? It's catastrophic. You can't sustain it. So I think a lot of people will say, even though I expect rates to come down, I'm still going to bring in the stock early to eliminate my risk of this 145% tariff that just destroys my business.
Definitely.
Yeah, you really have a lot of great insight on this warehousing and the great perspective there. I want to ask you, are there any other trends that we haven't touched on that you think could really shape e-commerce landscape in the coming years?
Yeah, the other thing that's going on is there's been a lot of fraud in the e-commerce space in particular, especially out of China. And as the tariffs have increased, the likelihood of fraud has gone up. So we've seen some conversations, both in the executive level and the House and Senate, around changing the laws around non-resident importers, bond requirements, and basically the U.S. allows Chinese companies to import to the U.S. with no presence, which means that if they commit fraud, there's not a lot of ramifications, right? Because there's no U.S. person to go after, versus Americans are much less likely to commit fraud because there's both large civil and criminal penalties for committing tariff fraud and things like, you guys discussed what we call border hopping or zone skipping, where people are shipping from China to Vietnam and Vietnam to the United States. It's actually classified as smuggling, which actually has like a 20-year maximum prison time for smuggling by misdeclaring goods, country of origin. U.S. companies are much less likely to take that risk. Chinese companies have been much more likely to take that risk. There's changes being at least proposed to change that asymmetry to make it harder for Chinese companies to cheat. So I expect other rules like elimination of non-resident importer, increasing the price of customs bonds, which will negatively impact some American companies, as it will increase the overhead and complexity of importing to the United States maybe a bit, but with the intention of reducing the cheating that's happening from non-U.S. entities selling to the United States.
In that scenario, do you believe that Chinese companies would just start purchasing possibly companies here in the United States to kind of work themselves around that situation at all? I think I saw you maybe talk about that a few weeks ago, but it would seem to me that the Chinese would just find a way to plant themselves somehow in the United States for that possibility.
Yeah, but which I think is fine. I don't think the idea here is to eliminate having Chinese companies operating in the United States. It's the idea of having these shell companies or these non-resident importers where they'll commit fraud, and if they get caught, they just shut down and come back under a different name. So it's to increase the accountability. Most other countries do require that you have a representative in the country. Like we operate in many countries around the world, and we're required to have someone in the country who's a representative, so that there is some liability. There's a person who's responsible. The U.S. doesn't. So I think changing that would require Chinese entities to do more work to have a representative in the United States, which does make it harder for them. But like the big ones will be fine. They'll set up an entity in the United States, just like we did, and have a representative in the United States.
Interesting. Well, Aaron, running out of time here. If people want to learn more about the work you're doing, of course, learn more about ShipHero, where's the best place for them to go?
Yeah, so I'm on Twitter or X and LinkedIn. I post a lot there. You can find me there. Our company is ShipHero, so we provide warehouse management software we power more than 1% of all e-commerce in North America. So if you're looking for warehouse management software, shiphero.com, and my email is aaron@shiphero.com.
I love it. Thank you, Aaron. We'll have to have you back on. Maybe we'll do a 90-day countdown, right? And get you back on and see where this ends up as well. For our audience, of course, be sure to go follow our newsletter. That's over at FreightWaves.com. Click on newsletters at the top of the page. And while you're at it, too, make sure you add Fraud Watch. And for all of those, of course, this week we're in Dallas, Texas for our fraud symposium. So make sure if you haven't got tickets for that you head to live.freightwaves.com and check out all our events coming up as well. Until then, everyone, keep on buying some things, especially it sounds like you might have a rush of products coming in over the next couple months. But until then, play it safe, and we'll talk with you soon.